Welcome to Profit Talks. I'm Profit. Today is Sunday, May 3rd, 2026. And in my opinion, it's been the quietest week in 2026 that we had between Venezuela, Iran, whole domestic situation in the US, elections in Europe. This was, I think, the first week that we didn't really have any big news. And I think it's a good opportunity to look at the wider world instead of just focusing on one issue. So today we will take a look not only on Iran, but more specifically on the issue of the Strait of Hormuz, how its closure can affect different countries. We will also take a look at the upcoming Trump visit to China and what we can expect from it. And we will also take a look at some domestic situations in the US that are upcoming, which is the new Fed chair coming in May, as well as the midterms at the end of the year. And we will try to understand how what is happening now is affecting those different spheres and those different events. So, starting with the Strait of Hormuz, as this is like the core of my discussion today, of my commentary. We have a new market on Polymarket on Trump announcing the end of U.S. blockade of the Strait of Hormuz, and the pricing that we get here is not great because what we see is that there are 28% chances of the end of the blockade by the end of the month. So this is essentially meaning that it's very likely that we will see the blockade continuing for at least another month. This is obviously awful news for the global economy. Additionally, I tend to agree with this pricing. I even think the chances here should be a bit lower, as the current stalemate that we are in is a really tough spot for both countries. And since both countries really, I think, believe they can outlast the other, we need this time, so we need this double blockade to sustain to actually reveal who is right. So what we have now, which is over 2 months of the blockade, will probably continue for the next month or even longer. And the effect of that will be visible now not only in Asia, where we have already a lot of restrictions and mandates related with saving the energy, as alternate days of driving, subsidies on oil, work from home policies, etc., etc. We'll also start to see that in Europe. And probably somewhere from mid-May, we will see the first signs, and starting late June or July, we should see like more profound effects on the economies there. Additionally, the Strait of Hormuz blockade by the US, if it's not lifted, we can pretty much assume that the Iranian side of the closure will also remain. And this market on general return of traffic through the Strait of Hormuz, I think, shows it best because we had 28% chance of lifting the blockade, and here we have only 19% chance of traffic returning to normal by the end of May. When we look even at the further market, which is end of June, here we have only 44%, so we ventured below 50%, and now it's more likely than not that we will not see normal traffic through the strait. And normal here is defined as 60 ships or above as a 7-day moving average of transit calls through the strait. So this normalization is not a single day surge. It will actually need to be a sustained traffic through the strait throughout at least 7 days. And what it basically means here is that both Iran and the US are betting that the other will blink first. So we are in a very expensive game of chicken in which both sides believe they have the upper hand. And everything has been showing us that we simply need more time, and with time we will realize which side is actually right, so who holds better cards. And we also have some markets in that, because on the Iranian side, the most important aspect of this blockade is access to either hard currency or just simply export of oil, because while Iran is really self-sufficient when it comes to the country in the Middle East, it still needs to import some food, some critical materials, and other stuff for the general population. But to import stuff, they also need to export stuff, so they need to at least barter, but ideally they need some access to foreign currency, and for that they need to sell the surplus of what they have, which is mostly oil. And here, while Iran has a pretty robust situation when it comes to imports, and can import through rail from China, from Pakistan, etc., it can import through the Caspian Sea. The situation with export is more difficult because Iran can't really export oil through the Caspian Sea because they don't have the infrastructure there. So there's no pipeline that drives the oil to the Caspian Sea. There's really no client that is willing to buy their oil at the Caspian Sea, be it Azerbaijan, Russia, or Kazakhstan. They all have different sources of oil. And rail is not actually effective when it comes to exporting oil. So what the US and Trump is actually betting on is that Iran will fall because of their inability to export oil. And the best proxy that we have on how dire the situation is actually the exchange rate of Iran and Rial, which is far from ideal because most likely there is a black market for the currency. The actual rate may be a bit different. There is like the page here, this bombast. I'm not sure if this is the official rate or if this is a black market rate. If you don't know what I'm saying about it, it's like the situation has been happening in different African countries. For example, take a recent example is Nigeria. In the last few years, they had a peg against the US, at least at the official rate. But obviously, they didn't have enough USD to actually enforce this peg. So in reality, in Nigeria, you had a black market for US dollar, and on the black market, there were occasions that the actual rate was 2 times the official rate. So this is Iran's free market, so we can assume this is some kind of a black market rate. And here we can see clearly that the situation, since the blockade has been enforced and pretty much since the war has started, has been deteriorating fast. So now the real is approaching, like US dollar is approaching 1.9 million reals for $1. And this is a very good indication that despite what is being said in the media, the situation is tough for Iran. So sooner or later, they will have problem accessing foreign currency or any hard currency for that matter. And the problems will start to pile up when it comes to export and import. And then the real economy inside Iran might start to struggle. But for now, I don't think that's happening. I think we would need a lot more issues, up to the point probably that the walls in Iran would need to be shut in and international trade will halt. For now, we know almost nothing about it. But we expect, and we should expect, that the situation is not tragic. And when it comes to the rest of the world, it's not that easy as well, because while Iran might be struggling, they have plenty of food, they have plenty of resources, and they surely have at least a few months of runway before real issues start to appear and the economy starts to crack. On the other side, we have rest of world, because while the US might be insulated a bit from the whole issue, they have their own oil, they have Canada, they have Venezuela and other countries in the Western Hemisphere, they have plenty of natural gas. So generally, they won't feel the effect of the blockade as quickly as countries in, for example, Asia and Europe. Asia and Europe is also important when it comes to US, because when the crisis starts to worsen, we may have a domino of countries first developing, then developed, that first go into recession, then into energy crisis, and then even into a government collapse. So while we don't really have a proper way of tracking like civil war chances, what we can take a look at is chances of main Asian and European economies going into recession. Because if in Asia Japan goes into recession, we can easily assume that poorer countries like Indonesia, Thailand, Vietnam, so Southeast Asia in general, India, Bangladesh, etc., will have even bigger issues. And here, what we see for now is that chances of a recession in Japan, and recession is defined as 2 consecutive quarters of negative GDP growth. Here, they lay at 37%. It's not exactly a very liquid market, at least for now when we see the order book. It's not that the spreads are not that wide, but you see the liquidity is really not there. But I assume that in the next few weeks this should change. Maybe we should get some liquidity here as well. But even at these small volumes, the 37% is pretty elevated versus what we should expect otherwise, because Japanese economy, while generally struggling a bit because of the deflation and a population crisis, was still doing fairly well. But with oil and oil products being inaccessible by Japanese companies, it can change really fast. So 37% here is clearly elevated. It's a high risk, especially since other Asian economies, especially poorer ones, will approach this point a lot faster. And when we take a look at Europe, we have pretty much the same situation, but here it's kind of worse because UK recession is priced at 50 cents, so this is basically a coin flip at this point. And while UK has been struggling a bit since it left the European Union, this is still the same region that has the same problems when it comes to oil. So it is a very good proxy on what will happen generally on the continent. Ideally, we will have some markets on French recession and German recession as telltales for the whole region. But doing here with the UK, 50% is very elevated level. And as I've been saying, since problems can appear in Europe pretty much since end of June and July, it's a perfect mix to induce a recession in an already struggling region, because Europe has been struggling with the Ukraine war for years now. It's been struggling with migration, and it's been struggling with a lot of different things, like over-regulation is one. So adding another crisis and energy crisis on top of it may prove to be too difficult to contain, and we'll actually see a proper recession there. So these two markets, which is Japan and UK recession, are clearly interesting to track. I do hope we'll get some more liquidity on them, as I think these are important indicators of where we are going with this whole Strait of Hormuz question. So generally, to sum up the segment of the Strait of Hormuz, I would say that the situation on the Iranian rial, as well as the situation on the recession markets in Japan and UK, are clearly showing that both sides are really taking a huge hit. I think it's too early to say who is worse off and who is better off. We also don't have a lot of insight into what is happening inside Iran. And we still need to wait for the effects of the blockade to actually materialize, both in Japan and in Europe. But what we're seeing here is very elevated levels of stress when it comes to economies there. And I expect we will see even more of that in the coming weeks and months. That being said, the only real solution to the situation we have is a diplomatic one. So a solution in which the US and Iran come together, agree on some terms, open up the strait, and at least allow the rebuilding process to begin, because the movement of oil, which is the most important one, started immediately. We had a lot of damage to infrastructure in the Gulf countries, some wells shut in, and it will take probably months to actually go back to proper production. So the effects on the global economy will actually be felt for months to even years. And the best way to figure out if we get any solution soon is an actual diplomatic meeting. And here, the prospects are not actually great, because we have only 38% chance we'll have a meeting by the end of May, which is pretty much aligned with the end of blockade, because traders generally assume that any pause or end of the US blockade should happen after a diplomatic meeting when something is agreed. So the pricing here makes sense, but it's not very optimistic. I would tend to agree with it for now. If anything, I will give a lot more chances of the meeting post-Trump visit to China. And so as you see, the market also thinks pretty similarly here. Meeting by May 15th, there's only 18% chance, and so the majority of the probability is cumulated in the second half of May. Additionally, what we also see here is that meeting is likely by the end of June, as traders expect that by this time one of the sides will need to blink. But coming back to this China meeting, there's also other reason that traders believe that majority of the probability of the meeting should be concentrated in the second half of the month. And the reason is pretty simple, and it's the China visit. It's not only because there's little expectations that the US delegation will go to Pakistan or wherever to negotiate before the visit, is that China might prove to be an important party to the coming agreement. So the issue that we currently have is not only that the two sides, so Iran and the US, cannot really agree on the terms. The other issue is that there is really not a lot of trust between the two. The US doesn't really trust Iran, and Iran really doesn't trust the US, considering that the last two times it's been negotiated, it ended up in strikes. So there is some expectation that Iran situation and the Strait of Hormuz situation will be discussed between Trump and Xi, and there is a chance we can expect some kind of development, because at the least, at the base case, China would be a perfect guarantor to any kind of deal. Iran has a lot more trust in China than simply US and Israel. So if China agrees to guarantee a non-aggression pact, for example, it's a huge step forward that should build a lot of trust that was eroded between the two sides, and maybe can allow for a deal. So here, as you see, the meeting is pretty much confirmed. There are people tracking U.S. airplanes, and they saw some of the U.S. airplanes landing in Beijing, and those airplanes are usually sent pre-meetings to actually prepare the site for the arrival of the president. So that's why you see here the chances increased really much, from 61% up to pretty much 89% now. So the meeting is pretty much confirmed, and there is a chance it can result in Iran and the US getting closer to each other. And while this is good news, traders still don't have a lot of faith that there will be some kind of permanent peace deal. So generally the situation is tough. As you see, by the end of May, chances of a peace deal are at 18% now, the lowest they have been, I think, ever yet at all. So the lowest they've been ever. But at the same time, this is mostly because there's really not a lot of clarity on what actually can happen in China. So in case we get really bullish developments when it comes to the deal, we should see the chances of a peace deal spike here. So from 18%, we can go even to 50%, depending on the messaging and by the end of June, I would say the chances should go way above 50%, especially since we should expect Trump to want to wrap up the whole situation before the World Cup in the US. So, to sum up everything, I think the what the markets show us is that for now there is little hope that anything can change. But considering uh, how the probabilities are distributed on this market, so US-Iran diplomatic meeting, uh, there is some hope that the China meeting that is happening May 14th, May 15th, can produce some good results and at least build some trust or help to build some trust between the US and Iran. Ultimately, though, the situation is still very difficult. We're still in a stalemate, and this is still a very expensive game of chicken that is being played. And some time is also needed for both sides to come to their senses. But coming next, we've touched on Iran, we've touched on Asia, we've touched on Europe, but really didn't touch on the US because, as I've said, it's pretty insulated when it comes to economic effects of the blockade. But while it's true that the US shouldn't feel a lot of effects when it comes to economy, this is a very important year in the US because we have both the midterms at the end of the year and the new Fed chair being selected. And as we know, Trump has been in a kind of a war with the Fed, and the situation. We have two components here. So one is the war in the Fed that is not exactly connected to Iran, and the other one is the midterms, which is very connected to Iran. So let's maybe start with the midterms. So as you see, here is a balance of power market. This is a market that shows us all the outcomes that are possible through the midterms election. So either we get a Democrat sweep, so Democrats take the House and the Senate, or we have Republican Senate, Democratic House, Republican sweep, so the same situation but reverse as Democratic sweep, and Democratic Senate and Republican House after the election. So currently, as we have it, there is a slight majority Republican both in the House and Senate. For quite a long time, the situation in which the Democrats take the House has been priced in. This is not exactly shocking. This is usually what happens in the midterms. I think every recent president lost the House during the midterms. But the situation that is starting to emerge, especially since the Iran war, as you see here, this is end of February, and the first crossing here was after the first week of the war, is that now the market pretty much expects that the most likely situation is a Democratic sweep. And this is a very difficult situation for Trump because while he tries to expand the executive power through the executive orders, through his constant war with the judiciary, his constant war with the press, the real the thing is that the Congress in the U.S. actually has a lot of power. As an institution, they set up budgets, they force shutdowns, they can generally do a lot of stuff, and without Congress, Trump may be in a way more difficult situation. Additionally, if the Congress turns Democratic, so we have a Democratic sweep, then the calls for impeachment may start to arise. So one should think that Trump should really be worried about that and at least try to keep the Senate. But then the whole Iran war, the rising prices of oil, the rising prices of fuel at the pump, generally that the public doesn't really like this war being fought. This makes me think a bit, and I think this also makes think some other traders that Trump doesn't really care about Congress at all. So ultimately, he's a very old guy. He won't start for president again. The Constitution doesn't allow it, and I don't think he has it in himself to actually be the president for another 4 years. So there are starting to emerge voices that Trump, in fact, might not care about midterms at all. He might just want to expand executive power even more, engage in the some kind of like a political civil war between the executive branch and the judiciary, and now the legislative branch, and he'll just simply not care. Like, realistically speaking, chances of impeachment, even if the Senate is lost, are rather low because impeachment needs 2/3 majority versus a simple majority. So even if Republicans lose the House, Democrats will never get 2/3 to actually impeach him. Surely they can try to impeach him as they did during his previous term, but there's very little chance it will succeed. So if that's true, if Trump really doesn't care that much about the midterms because he's all about his legacy and foreign policy, solving Iran, solving Ukraine, solving Cuba, solving Venezuela, then Democratic sweep is probably a real bargain at this point at 49 cents. But this is just a theory. But we can clearly see that there's a trend that back in October, traders even expected that a Republican sweep is more likely than a Democratic sweep. This is way back when the situation was a lot different. There were no Venezuela, basically no Iran situation at all. It's just Ukraine, solved Gaza. This was a very good moment for Trump, especially post solving Gaza and post the tariffs that didn't really do much in terms of hurting the economy. But as you see, the situation changed pretty dramatically soon after, and after the Iran war. We have now Democratic sweep as most likely, and Trump doesn't seem to really care. So maybe in the next few weeks, in the next couple of months, we'll even see if the war is not solved, the Iran war, and also the Ukraine war remains unsolved. I expect to see the Democratic sweep going higher as the situation that is inside the US, both political and the impact of the higher oil prices, will push some previous Trump supporters to actually stay home, and will push the Democratic supporters to go out and try to change the situation. And lastly, it's been a quite long video. I want to say a bit about the Fed, because outside of the midterms, Trump is also fighting the Fed. He was trying to force Powell to lower the rates for quite some time. He even opened an investigation into the construction works in one of the Fed buildings, as it turned out to be extremely expensive. At the same time, there were some problems with confirmation hearings of the upcoming Fed chair, which is Kevin Warsh. But anyway, with all that happening, everyone expected that, as it is customary for Fed chairs, that Jerome Powell, once his term as chair ends, will also resign from the Fed board, because his term at the board ends actually, I think, in 2 years. I'm not sure now, but I think it's 2 years. So as you see, it was pretty much expected he will resign by end of May, which is when his term as Fed chair ends. And when we look at end of year market, it's pretty much close to certain that he will resign, trading just below 90 cents. But then, even after the rumors that the investigation into the construction works is being dropped, Powell went out and didn't really say it exactly, but suggested that he might stay on the board if he feels that that its independence is being somehow in danger. So this is clearly an interesting development, because even without this situation, Kevin Warsh would have a very difficult time in actually lowering the rates, because for the decision to happen, he actually needs the board to support him, so he needs to build consensus. With Powell in and actively trying to undermine him, this job will become even harder. So this was a very big revelation. And if it comes to that, and this is really training as if it will come to that, then we'll have a real tough situation inside the Fed, inside the monetary policy, and it will definitely anger Trump and, but most importantly, stop him from implementing some of his ideas or some of Scott Bessent's ideas about where the interest rates, the Fed rates should be. I don't want to spend too much time on Powell now. I think I will get to that a bit later, maybe next week, depending on what we see in China. But it is what it is. It is a very interesting situation. I initially expected also that there shouldn't be any problems like that, but we are where we are. Powell might think this is also his legacy. He may want to be remembered as the next Volcker or whatever. And he'll actually may try to fight Trump in the Fed, hindering his agenda. So that's all for today. Thank you for listening. If you like the video, leave the thumb up, leave the subscribe as well, as I do this weekly. And if you want to hear or to read some of the deeper analysis I make with some alpha where I present my research around global events, then take a look at profitnotes.com, which is my Substack newsletter, where I publish weekly pieces, like both free and paid, on all kinds of global events, geopolitics, politics, elections, etc. Additionally, I am also on X, where I post daily my thoughts and snarky comments, so if you're into that, also come on in. And thank you for listening, and see you next week.